So it's related to the analysis of financial statements. Now what it actually relates with the financial statement? Now whenever we talk about the balance sheet, profit and loss account, the trading account, all these are basically related to the financial statements. And why analysis of these financial statements is important? Because being a banker, we need to look through the repaying capacity of the borrower, we need to check the viability of the project, we need to check the net worth of the capital, and these all factors can be ascertained from the financial statement itself. Okay, now first of all, what is actually the net worth? What is net worth? So net worth of the applicant is excess of the assets over the liabilities. So when your total assets are greater than the liabilities, in that case, that's the net worth. So net worth basically helps us the bank to decide, so as to check the level of the activity that the bank is basically deciding to finance. Okay, so whatsoever the level of activity that is basically desirable by the applicant over there, whatsoever the amount that can be lent to the person, that can be ascertained by way of checking the net worth of the applicant. Second, it is related to the repaying capacity. Definitely you can look into the repaying capacity, that what amount the person can do spare, and that we can go through and further can ascertain by way of examining the financial statements over there. Then third, it is related to viability. So whatsoever the project that is going to be undertaken by the firm itself, would it be viable enough? Can it be a reality? Okay, so that all can be ascertained by way of the financial statements. And it is related to availability of the securities. The audited financial statements indicate the type of the charge on the assets of the borrower. So what type of charge is created on the assets of the borrower? Bank can assess the level of the unencumbered securities so available. Now what is unencumbered? Unencumbered means those securities on which none of the charge is created. Okay, so these are the aspects over there. And further, which are the financial statements? So which financial statements are there? So it is related to the balance sheet, it is related to the profit and loss account, and apart from this, auditors report, explanatory schedules, notes on accounts. So there are actually we can say the balance sheet and further the profit and loss account. These are the main statements over there. And other than that, there are different schedules. There is the auditor's report, and further footnotes are over there, which basically narrate each and every detail over there. Okay, and other than that, we are having the fund flow statement. These are also basically useful so as to determine that how the funds are flowing in the firm itself, how the funds are basically the inflow of the funds and outflow of the funds. And cash flow statement is also there, which let us know what is the actual position of the cash. So we will be discussing them all in detail over here, do not worry about that. Okay, so we will be discussing each and everything over there in detail. I'm just giving an overview that what financial statements are there. So we have covered that there is balance sheet, there is profit and loss account, there is cash flow statement, there are different schedules, there is auditor report, there is fund flow statement. And other than that, we are having the different standards, accounting standards are over there, which basically make it mandatory for some of the organizations. And for which organizations? Such organizations which are listed on the stock exchange, and further which organizations are having the turnover for the accounting period above rupees 50 crore. They also to prepare the cash flow statement that is related to the accounting standard 3. So it's mandatory for those organizations which are listed on the stock exchange, or who are having the, or which organizations are having the turnover greater than 50 crore. Okay, that is where and they have to prepare the cash flow statements too. And also they have to segment wise reporting, they have to do the segment wise reporting. So whatsoever segments are there, whatsoever the different industries dimensions are there, they have to report accordingly. Okay, now let us have a look at the users of the financial statements. So who require the financial statements? Financial statements are meant for whom? These are meant for creditors and lenders. So if you want to lend to some person, definitely you want to look into that what is his repaying capacity, what are his financials. Investors also do require. It's important for the government agencies too, because they want to ascertain the taxes over there. Rating agencies, which basically do rate the different products and further the instruments. And then it is related to customers. So being a customer, if you are associated with some bank, definitely you are maybe interested in the financials of that particular bank also, because you'll be worried enough now that if your money is safe with the bank or not. And also the employees who are working with the team itself, general public, analyst. So these are the users of the financial statements who do require the financial statements. Okay, So let us have a look at the basic concepts that are used in the preparation of the financial statements. First of all, it is the entity concept. Now the entity concept says that business is considered separate from the entity itself. It is basically a separate entity from the promoters, investors, shareholders, etc. So it's as per the entity concept. It's as per the entity concept that business is a separate entity. So if we say that person A has invested and further has basically incorporated an organization over there, so we'll be saying that ABC organization is separate from person A over here. That is actually the entity concept over here. So whatsoever the capital which has been basically invested by person A, that's a liability. That's a liability for the firm ABC. Why the capital is a liability? Because it's a liability on the firm that it has to repay the amount back to the promoters, back to the investors over there. Then it is a money measurement concept. The second concept that is used in the preparation of the financial statements, that is a money measurement concept that is related to accounting is done only for those transactions. Accounting is done only for those transactions which can be expressed in the monetary terms. Which can be expressed in the monetary terms. Only those transactions can be basically taken in the accounting. So if you cannot measure anything in money, those transactions will not be acceptable in the accounting itself, because those will not be comparable. If you have measured the if you have measured the assets or liabilities in terms of the monetary funds, in that case you can do compare them. That is the second concept. And the third one, it is related to the going concern concept. So whensoever an organization is incorporated, it's incorporated keeping that particular thing in mind, that it will basically remain there for a longer period. It is going to be a going concern, that it will be basically continue to business for the indefinitely long period, and that is a going concern concept. Then it is a cost concept. That it is related to cost concept. The cost concept says that whatsoever the assets that will be acquired by the firm itself. If I do consider the XYZ firm over here, and if I say that they have do purchased a machinery over there, in that case, what does it signify? That this particular cost of the machinery, that this particular asset will be basically recorded at what price? It will be recorded at their cost. It will be recorded at the cost over there. So as the unrealized profit is not accounted for, and if no cost is incurred, if the item is not to be taken into the books itself. So what does it say actually? So it says if there is unrealized profit, it is not accountable for. And further, if you have received machine for free, it will not be basically taken as an item into the books over there. Is that clear? Is that particular part clear over here? Further, the next concept, it is a conservation concept. It is related to the conservation concept. It states that no profit should be anticipated. So if you have any profit that is anticipated, let me give an example. Let us take the case that you just received an order amounting rupees 2 lakh. You just received an order amounting rupees 2 lakh. Now this is basically an anticipation that you will be receiving rupees 2 lakh on completion of the order. It's just an anticipation. You are basically not a rightful owner so as to receive rupees 2 lakh right now. So that profit is not to be accounted for. But if there is any anticipated losses, those must be booked. If there is any anticipated losses, that must be booked. But if you're having anticipated profits, those are not to be accounted for. That is basically the conservation concept. Then it is a dual aspect concept. Now the dual aspect concept is actually very, very important from the balance sheet point of view. What it actually basically it concerns with, it says that each and every entry is having dual aspects. It is having the dual aspects over there. So if I purchased a machinery, it will basically increase the amount under the asset account. It will basically increase amount under the machine account over there, and also my cash account or the bank account will be lowered, or my cash account or bank account will be lowered, because I must have paid either using the cash, or I must have paid using my bank account, or I must have basically taken the machine on credit itself. Okay, so it will be basically covering two accounts. Each and every statement will be having at least two accounts associated with the entry itself. Okay, further it is related to the accounting period concept. It is related to the accounting period concept. The business is segmented into appropriate parts to check the performance. Now, if you do not basically take into account the accounting period, you will be basically accounting for a longer period. Okay, right now if I say the accounting period is from 1st of April to 31st of the March. Okay, but if I say there is no accounting period, and further if you want to compare, how you will be comparing? How you will be comparing with your performance itself, and how you will be comparing with the industrial performance itself? It will be quite difficult now. That is why the accounting period concept is there, that the business is segmented into appropriate parts over there, and such segment is called what? That is called the accounting period. Then it is an accrual concept. That the income or expense to be recorded as when they become due and not on transaction basis. So if I say that the interest was charged, interest on the loan accounts, interest in the loan account was charged on 31st of March 2021, the interest charged was basically interest was charged in the loan account. Now, when the interest is charged, it is basically bank become the rightful owner, because when the interest became due on this particular date, the bank will become the rightful owner so as to receive this interest. It is not the case that the customers have paid the amount. It might be the case that the customers have not paid the amount. But even if the customers have not paid the amount, because the amount is now due, now the bank is basically a rightful owner so as to receive the amount. So that basically means what? That basically means that the accrued amount in the loan when became due on 31st of the March, the bank can basically take this particular amount in the profits over there. Are you getting this particular point? Let me clear this to you again. So if I say that the interest was charged up to 30th of March, interest was charged amount rupees 10,000. 10,000 was interest was charged, but it was accrued interest. It was accrued interest, but not yet due. When the interest is accrued, that it is basically accumulated over the interest, accumulated again and again over the period, but the bank basically the interest never became due till 30th of March. Okay, in that particular case, the bank is having no right to receive this 10,000. The bank is having no right to receive this 10,000 amount. Okay, but on 31st of March, this interest became due. Now bank will be becoming what? Bank will be becoming a rightful owner. The bank will be becoming rightful owner so as to receive the interest. Now the bank can basically account this interest accrued for its profit purposes. Okay, so that is a concept over there. That is accrual concept, that the income or expense to be recorded as when they become due, and not on transactional basis. Is that clear? Then it is a realization concept. That revenue can only be recognized once the earnings associated with the revenue have been delivered or rendered. So when you have delivered or rendered the services, only then the associated revenue can be basically recognized. Associated revenue can be recognized only when you have earned it. Earned it, not before that. Okay. So when you have basically delivered the goods or you have rendered the services, only then you can basically recognize your earnings over there, revenue over there. Then it is related to the matching concept. So incomes and expenses in accounting period must be recognized as and when they accrue, and not when they are received or settled respectively. What does it indicate actually? So if I have paid on January 10th, I paid rent for the whole of the year. I paid rent for 12 months over there. Now, as per the accounting period, the accounting period will be till 31st of March 2022. It will be till 2022, and the next accounting period would be related to the financial year 2022-2023 and not to the previous financial year. Okay, so for the financial year 2021-2022, only 3 months would be accounted for, that is January, February and March, and the another 9 months would be basically accounted in financial year 2022 and 23. Are you getting this particular point over here? Now at that particular stage, this expenditure related to the 9-month rent that you have paid in January itself, that must be accounted for the next year expenses, not in the current year expenses, because otherwise it will not give you the clear picture of the profits over there, because this particular expense related to the 9 months of the advance rent is not belonging to current year. It will be basically accounted in the next year itself. It will be basically accountable in the next year itself. That is a matching concept itself, that says that the incomes and expenses incomes and expenses must be recognized as and when they accrue and not when they receive or settled respectively. Okay.